Imagine getting an A+ on your final exam, delivering arguably the best performance of your career, but your teacher still sends you to detention. That's kind of the bizarre situation Duolingo, ticker DUOL, is finding itself in this morning. The language lesson the market's giving them is one of pain. Welcome to D-Risk, a podcast where we provide a no-nonsense analysis of stocks.
Hey there. Yeah, today we're doing a deep dive into Duolingo, DUOL. We're analyzing our research, which we captured this morning, November 6, 2025. And we should probably set the macro stage first. The broader market is generally feeling cautiously optimistic. There's this belief the rolling recession might be ending. But, with major jobs data and Fed officials speaking today, it feels like we're walking a very volatile tightrope.
Right. Definitely some nervousness out there. So our mission today is to figure out why on earth a company delivering such outstanding Q3 results is collapsing over 21% in pre-market trading. Why is the stock getting punished for what looks like success? Let's dig into those numbers. Wall Street seems determined to ignore for a second. Revenue soared 41%. Daily active users, the DAUs, they jumped 36% to over 50 million. And paid subscribers are up 34%. They're successfully converting free users, maybe helped by those new AI features they rolled out. Based on this, the stock should be flying high.
Well, yeah, and that's the core conflict, right? The good execution is being completely overshadowed by fear over the forward guidance. The stock collapse seems to be a direct reaction to management saying, hey, we plan to aggressively ramp up spending on long-term growth initiatives. And the market just heard increased long-term investment and immediately translated that to temporary margin collapse and lower near-term profits. Boom.
But hang on, for a high-growth company, especially one playing in the AI space, isn't ramping up spending exactly what growth investors should want? Are analysts just being, fundamentally short-sighted here? Punishing them for investing in their future engine?
It definitely creates this intense valuation conflict, driven by that uncertainty. Our research shows one free cash flow model suggests a fair value way up there, over $400. That implies massive, untapped potential if these investments actually pay off down the line. But the immediate fear, that fear of margin compression, that's triggered analyst caution. We're seeing a noticeable spike in hold ratings and even a new sell rating popped up.
And that fear is translating into some really severe technical damage on the chart. The stock closed yesterday up at $260. Now it's indicating an open near $204. That's a massive gap down. It really shows you the market is just instantly pricing in the absolute worst case scenario, doesn't it?
Oh, absolutely. The technical signals from our research are decisively bearish right now. The price is trading way below all the critical long-term moving averages. And what's particularly concerning is the volume. The selling pressure is heavy. That confirms this isn't just some passive profit taking. It looks like a strong, intentional capital outflow. The momentum is accelerating hard in reverse. The engine's revving backwards.
Yeah, what's fascinating here, though, is the sentiment battle before this happened. Our research showed pre-earnings options traders were actually surprisingly bullish. They registered a pretty low put-to-call ratio, 0.64, which for you listening, that means significantly more people were betting on a rise than a fall. But they were going up against a pretty significant short interest, nearly 11% of the float. So today is setting up this really violent conflict between those short sellers who are now cashing in big time and maybe some aggressive dip buyers trying to call the bottom.
Right. So bringing it all together, our overall verdict right now is neutral with a bearish bias. Here's the why. Duolingo, the company, looks great, the fundamentals are strong, but Duolingo, the stock, is frankly technically broken right now. And that breakdown is so severe, it's likely going to overshadow the good operational news, at least in the short term, until the dust settles a bit.
Okay, so what are the main risks that could flip this bearish view? What could make this selling stop?
Well, the primary counter risk, I suppose, is that the stock is now technically deeply oversold. That means it could be ripe for a sharp short covering rally, where shorts are forced to buy back shares just to lock in profits or cut losses. Plus, that underlying fundamental strength, that impressive growth, that should eventually attract some true value investors who are looking at that potential $400 FCF number you mentioned. Exactly, and the critical battleground we're watching over the next few sessions is really that $200 to $205 zone. The panic kind of needs to start there. However, the key psychological level for the bulls to actually reclaim, to signal maybe the worst is over, is $215. A sustained move back above $215 would be the first real signal that the market is starting to, perhaps, forgive management spending plans and look longer term again.
It feels like Duolingo just taught a masterclass, maybe unintentionally, that when Wall Street gets spooked about future spending, That fear of execution risk and lower near-term profits can just instantly outweigh even the best report card you've ever seen. Guidance matters.
That's all for this episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.